Hi, I'm Winston, and welcome to the Real Estate Template, where we're going to teach you that there's so much more to real estate than just looking at houses, buying land, buying buildings. We're going to teach you how to dissect the deals down. We're going to teach you how to recognize a good deal compared to a bad deal. Today, what we're going to do is we pulled a couple of houses off of the MLS. One of them is kind of older, not renovated. One of them that is. And we're going to do some comparisons. We're going to look at them. We're going to say, are these good deals? Are they not good deals? So we have people asking us about deals all the time. If you have a question about a certain deal you want to do, send it to us. Let us know what you're looking for. We can pull it up, maybe do a podcast on it and help other people understand some stuff that you're looking to learn. So we're going to get into this right here. We're going to switch over. And this is an old house. I got a better picture of the house in a second. But I just wanted to go through some demographics on that house. So we're looking at a house that's 2-bedroom, 1 bath. It's an older style house, as you see. It's 906 square foot. $165,000. Zillow has a Zestimate of $162,000 for that house. I think Zillow is out of their mind, but we're going to look at it, we're going to dissect it down, and we're going to see what makes sense for an investor. This house was built in 1948. This house has window units and electric heat, so it's going to have baseboard heaters, not any heat in the window units probably. It's probably all going to be baseboard. Then the lot that it sits on is about 1/6 of 1 acre. So it's 7,405 square feet of lot at $182 a square foot. So as we look at that right there, we look at the house. We see that the house has vinyl siding on it. It's not new, it's been there for a while. Underneath that vinyl siding, I'm familiar with the neighborhood, underneath that vinyl siding is going to be asbestos tile. Not a big deal. It's covered up. It's not a big deal, but it does not help you at all when you're trying to decide whether you want to buy something or not. It's a deterrent for some people if they're going to buy it if it's got asbestos siding behind the vinyl. The windows, as you look at them, all the windows are the original windows, so the windows have not been replaced. Old guttering, the roof's 3-tab shingle. I would say that roof's probably 10 years old. Maybe another 5 years left in it, 10 years left in it before you got to start thinking about changing it. Just an old fence, so the fence isn't anything new, anything nice. It's just a plain Jane, older house, simple construction. I look at it, and Zillow is telling me that this house right now is worth $160,000. Right here in 2022, maybe midway through the year, that house was banking under $100,000. So they took a lot of price adjustment in 2022 to make that house catch up with market standard. Now, if we were still in an environment in 2023 where people are coming in giving $50,000, $60,000, $100,000 over asking price on a house like this, then maybe I could understand their numbers. Right now, I'm leaning towards them being a little high, but we haven't run any numbers yet, so let's look at that and see how it's going to be. They're ranging it from $151,000 to $170,000. So that's a pretty good breakdown of it. I put a line right here. I drew a curve where if we was on a regular curve line going up, that's averaging about 5% return on investment a year on appreciation with the house. So that would put it at about $110,000, $120,000 probably at a good market price if we didn't have this huge spike and dip in it. We had a huge spike here. In 2019, it came back down. Then we had another one that came up in about 2021. Then it came down, and 22 went level, and then it went up again. So I would assume this spike is going to continue to come down. Now we're going to look at, they're saying that you can buy that house at $165,000 for $799 a month. I'm going to show you where that's not going to work for you. Then they're also saying that house should rent for about $1,335 a month. I'm good with that number, so we'll stick with that number as we do our calculations. But the rest of the numbers, we're just going to let them be what they are. So we're going to start off with cash on cash. If you look back, we have a couple of videos back behind this one. One of them does cash on cash. One of them does cap rate. We're going to run this both ways so you can see it, but I'm starting off with cash on this particular one. So cash on cash is investing. In investing, the cash on cash return is the ratio of annual return before taxes, so before you pay any taxes on your cash flow, to the total amount of cash invested expressed in a percentage. So you invest $100,000 and you make $10,000 a year off of that money, then you are making a 10% cash on cash. So I'm not going to go step by step. If you want to look at this on a step-by-step basis, explained a little more in depth, then go back to the cash on cash video and look at that one right there. We're going to still explain it pretty good, though. We're not going to walk away without explaining it. So we take that house at a total cost of $165,000. Then I look at that house and I haven't seen the house, I haven't been inside of it, but I know that if I'm going to rent it to a tenant and put a good tenant in it, because they haven't really done anything to the outside of it, chances are everything on the inside is outdated. So knowing that it's outdated, I would assume that I'm going to put at least $15,000 in that house. So I'm putting repairs at $15,000. So if I pay $165,000 for it and I put $15,000 into it, now I got $180,000. At $180,000, I'm going to pay 3% closing costs, which is going to give us the $5,400. So by the time I pay the price of the house, the offering price of the house, I factor in my 3% closing costs, which is going to be on everything I try and finance. I'm going to try and finance my repair costs and with the note, the other $15,000. So that's going to give me a total cost when I buy that project of $185,400. So with that, I'm going to put 10% down. So 10% down is going to be $18,540. So with the $18,540, that's what's coming out of my pocket, and I'm giving it to the closing agent when I close it. That is my total out-of-pocket money. So I'm going to finance $166,860. So I showed you a calculator in the previous cash on cash video that you can log into. I showed you how to use it so that you can actually run these numbers. So I would encourage you to, if you don't have that on your phone or on your iPad or something, put it on there. It's a great tool. It'll let you figure out what your note's going to be on any project in just seconds. So it's real good. I'll run it in a minute because I want to run some numbers backwards on some of these deals too. So I'm doing a bank loan for $166,860 at 6.5% interest. Now, maybe you can find something still in the fives. I don't see anything really. Most of it's in the sixes now. I'm going to go with 6.5 because I'm going to be safe. I'm not going to go out and try and figure I can do something that I probably cannot do. Over 30 years, that's going to give me $1,054 a month. So when I financed $166,000 for 30 years, I'm going to have a note of $1,054 a month for 30 years. That equates to $12,648 if we're going to look at it from a yearly basis. So my yearly expense on a mortgage is going to be $12,648. Carrying costs. We spoke about carrying costs also. So carrying costs is, let's say I buy that house, it's going to take me a month to get the repair work done and get another tenant in it or get a tenant in it. So I'm going to have to pay the note on that house. I'm going to have to pay the taxes on that house. I'm going to pay the insurance on that house. I'm going to have to pay any utilities I have on that house. So if you don't put this carrying cost number in there, what you did is you just threw $1,400 away. And whenever you're trying to figure out whether you're making money or losing money, you're not using all of your calculations. Don't not use everything because you want to know exactly what this deal yields for you. There's no reason to try and make it look better. If you're okay with losing the $1,400, then just say I'm okay with the fact that I lose that $1,400, but still put it in your numbers and then dissect your numbers down and know exactly what your numbers are. So we're going to use $1,407 for carrying cost on that deal. So my total out of pocket will be the $1,407 plus the down payment, which is going to be $19,947. So on all my calculations from here forward, I'm going to use my total out of pocket expense at this $19,947. So Zillow said that house would rent for $1,335 a month. It'll rent for $1,350 a month. I'm renting 2-bedroom houses right now for $1,500 a month. They're nicer than that right there, but if they'll pull that right there, somebody will come in and pay $1,350 for this one right here. So a $1,350 a month, and we do that for a whole year, that's giving us $16,200 worth of income. So the next thing I'm going to do when I do my $16,000 worth of income, I'm going to add a vacancy factor. So I'm going to factor in that house once every 14 months is going to be vacant for a month. I'm going to lose 1 month of rent every 14 months. So the reason I want to do that is I want to be able to put that money into my bank account, a separate account. I'm going to hold it there, and then when that month comes up that house does not rent, then I'm going to be able to have that money, put it into my checking account, and I didn't miss a beat. So ultimately, my revenue is going to average $15,066 a year, not the $16,200 a year. If you get the $16,200, that's great. Awesome. But I'm going to tell you right now, it doesn't always work out that way. So prepare for what can happen, not prepare for great times all the times, because that's not what we get. So with that being said, I need to look at my total expenses. So I put that on a different page. So I took my total expenses, my mortgage payment of $12,648. Then I figured in a property management fee at 8%. Maybe I manage my own property, which I do, but still, even when I manage my own property, I need to be paid for that time. My wife needs to be paid for that time. And sometimes we use our own employees to do it. Okay, they are paid for that time. So we figure in 8% and everything. You can go out and find a property manager to manage a piece of property for 8%. Now, if it is a complete crap hole piece of property, they're not going to manage it for 8%. They're going to manage it for 10% or 12% or 14%, because they're looking at how many times do they have to touch that property every single month in order for that property to function properly. They don't want to deal with something and not get paid for it. So we're using 8%. That's $1,296 a year that I'm going to spend to have somebody manage my property for me. I'm going to pay another $1,200 a year in insurance. Reach out to your local insurance agent that you deal with. Tell them what kind of house you got. They can give you a real quick estimate on what that's going to cost you for your insurance. Don't guess at it. Call them up, find out. I do a lot in this area. That's about what it runs me. Then you look at your property taxes. I'm putting $1,600 a year in property taxes. That's going to be about right. If you don't know, call your tax assessor. Say, hey, I'm going to buy this house. I'm going to buy it for $165,000. Can you give me a rough estimate on what my property taxes will be? They will give you a rough estimate on, hey, if this is what it is, we're going to give you $25,000, $50,000 for the lot. The rest is going to go to the house. This is what you're going to pay the taxes on. Then I always figure in maintenance fees. Throughout the year, you're going to have a maintenance call here and there. So if you have a couple of maintenance calls, $500 will cover that. If you have a piece of property like this house that we just showing, I mean, if it's not in good shape, if the $15,000 I have invested in it does not cover the repair and maintenance that's going to happen throughout that year, then I need to add more money to that $500. I can't just use the $500. So that is depending on how much money you realistically think you're going to spend on that particular house for that year. Then the next thing I got is legal and accounting. From time to time, you may have to file eviction on somebody. Maybe you never have to do it. But if you do have to file eviction on somebody, it needs to be included in your expenses when you're figuring it out. And I put in there maybe $150, $200 for that, $150, $200 for my legal expenses or for my accounting when my accountant does all my book work. And that brings me up to a grand total of $17,644 for my total expenses on this property. So let's go back to the previous screen. And you're going to look at that. I got my expenses here at $17,644. So with that being said, my total income, I'm going to go back up to my income with my vacancy factor, is $15,066. So I would lose $2,578 a year on this house. Now, in all scenarios, that's not bad. If you're in an area like California was for so many years, where it's appreciating at 20% a year, they ran a negative cash flow if you bought rental properties for the most part. You ran a negative cash flow. In that scenario, we could work with this deal. We're not in that scenario in Gallatin, Tennessee. Gallatin, Tennessee, it's done well over the last 5 years. But let's say it drops back down to where we're only getting 5% appreciation like the last 50 years has given us, then 5% appreciation isn't going to make that number look a whole lot better either. So I would walk away from this deal. I would not consider it at all at $165,000. I think that the property is too old. There's possible repairs that we haven't seen yet that are on the property. Always hire a home inspector to come in, look at your homes before you buy them, because they're going to find stuff that you're going to overlook. So always use a home inspector. I don't particularly like the home inspector's reports because they nitpick them so much, but at least I know the truth. I know the truth in what I got, and if I decide to not recognize something that they're showing me, that's up to me. But at least they showed it to me, and at least I know that we got that problem and we can fix it. So we look at this and we say, okay, what does make sense? So I went back and I ran it a second time. This time, I put the purchase price of the house at $120,000. That brought it more in line of the chart when we were doing the graph that was going up of where I figured the house would be worth. I put it more at $120,000, and then I only put $5,000 in repairs. So we got $120,000 in the cost of the home. We got $5,000 in repairs. Then we take 3% of those two numbers. That gives us $3,750, my closing costs. So my closing costs are going to be roughly $3,750. Now, if you are buying a house, I don't know what area you're in, call your title company and say, hey, I'm looking at buying this house. What number do I need to use for closing costs? 3%, 5%, 10%. Let them tell you what it is. All deals are not exactly the same. Call your closing title company, find out what that's going to cost you. So with that being said, I'm at $128,750. That's my total investment in purchasing the house. So this time I'm going to take 10% of that, which is $12,875, and I'm going to finance $115,875. So with that being financed, I'm going to use the same 6.5% interest. Then I'm going to have a $732 a month note. And if you notice what they showed earlier, that's a little closer to what they were showing, but they were using, I don't know where they get that numbers from on Zillow. So at $732, that's $87.84. So I got $8,700 a month in a bank payment. And then I'm figuring it's going to take me, half a month with additional expenses and stuff to get the house ready. I'm going to spend $989 on my carrying costs for a total all-in price out of pocket of $13,864. So with that number, we're going to use the exact same number we had as far as the $16,000 on monthly fees. But let's go to our expenses. So the only thing that changed on the expenses is I changed my mortgage payment to $12,648 a year rather than what they had. Everything else stayed exactly the same, but it reduced my expenses down to $17,644. Okay, so with all of that being said, this deal does not make sense to me in any way like it is, okay? So let's look at this deal. What can we afford to pay for this house? I don't know. I did some numbers, and what I came up with is $120,000. And I'll explain to you how I did the numbers in a minute. So I did the $120,000. I lowered my repair cost to $5,000, which put my total cost at $125,000, and then I did 3% on top of that for closing costs. So all in, I'm at $128,750. Your closing cost is something that you need to verify when you're running your numbers. Call your title company, whoever your closing attorney is, and say, hey, can you give me a good number that I can use or a good percentage I can use for my closing costs? Every area may be different, so don't take 3% and run with that. Find out from somebody, a real estate professional in your area, what are your real estate closing costs going to be, and they will be able to give it to you. If you're using a real estate company, a real estate broker, they can help you with that. They can help you with that number. So I'm all in at $128,750. I'm going to put 10% down, same as the last deal, $12,875. So what I'm going to finance is $115,875. So with that number right there, I'm going to finance it at 6.5% for 30 years, and I'm going to come out with $732. The 732 is more like the number that they had on Zillow's page. So I don't know what they were using. They were probably using more like a 4% interest rate instead of a 6.5% interest rate. So out of that deal, I'm gonna still add my carrying cost in. So my carrying cost is maybe I'm gonna be vacant for a half a month and I have to pay that half a month's worth of note on my own. Maybe I have to pay also some insurance on it. I got to pay a little bit of utilities on it. I got to pay a little bit of taxes. So all of that goes into this number. I figured that out to be $989 for the time that the house will be vacant. So that gives me a total out of pocket of $13,864. Our revenue stays exactly the same as it was, $16,200. Our vacancy rate stays exactly the same. Our expenses, however, are going to change. So as we look at this, wrong way. As we look at this, I did a different expense category. So with the mortgage payment added up, now we go from the $12,000 number to $8,784. Our property management fee stays the same. Our insurance stays the same. Our taxes stay the same. Our maintenance stays the same. Our legal stays the same. Only thing changes is the mortgage. But the total expenses is now $13,780. So when we back up, we put that $13,780 in there for total expenses. And now we're making $1,286. Now you look at that and you say, well, why would I go through all of the trouble of buying a house if I'm only going to make roughly $100 a month? That doesn't make any sense. I don't want to spend all this time and energy for $100 a month. Well, $100 a month equals 9.2% return on investment whenever you look at your total out-of-pocket money at $13,864. So you're still making a 9% return on investment. You take that 9% return, you're going to be able to make your principal reduction. We talked about that in a previous video. So if you don't understand that, go back to that video. It's talked in depth about it. You're going to make your tax advantage, so you'll be able to get depreciation off of that right there. It's about 3.6% a year. Then you're going to be able to get your cash flow. You're going to be able to get that right there. And you're going to be able to get your appreciation. At $120,000 on that house, I would look at that house to continue to appreciate at 5% a year, because it will. At $165,000, I don't see it appreciating at 5%. Not right now. I mean, our market may do a pullback, but if the market did a pullback and you purchase that house at $120,000, you're not going to feel it. You're not going to see it at all. It's not going to pull back past that number. The numbers that are pulling back are the numbers that are overstated, where people paid $100,000 more than a house was worth. Now those numbers are pulling back, and they're not really pulling back past what the original number was. They're just pulling back to where the number should be right now. We haven't seen a whole lot of pressure on that. But 9% is a good percent. So one thing I'm looking at on this right here, as I look at this, I take my total price of $115,000 that I got invested in that job. I used to use an algorithm of 0.006, and then it went up to 0.007. So I would take the purchase price, I'd multiply it times 0.006, and that would tell me this is exactly how much money it's going to take me to run this deal on a monthly basis. So if I took this right here and I multiply that out, it would give me what I need my number to be on my rent, the $1,350. So now we're going to look at it like this right here. We're going to use the number of 1%. I think one is what people used to want, and that gave them a profit. One isn't a number right now that you're going to use to really make any good profit. One is a number that you're going to use, and I'm talking about taking your total purchase price and multiplying that times 1%. And this is just right now. We're in January of 2023. So these numbers are always changing. So for today's standard is, if we took that $125,000 or $128,000 total, and we multiply that times 1%, that would give us $1,280, which is a little bit less than that right there, a little bit, roughly close to $100 off, right? That would give us a zero profit. So at 1%, a quick way to run the deal is, hey, if I'm buying a house for $200,000, multiply times 1%, that's $2,000 a month. Can I get $2,000 a month off of it? If you can get $2,000 a month off it, then you say, okay, let's start looking at some numbers a little closer. That's just a shoe from the pocket. It's a shoe from the pocket. This gives me a thing. Do I want to even look at this deal? If it doesn't come in close to that, like the $168,000 was looking at, don't even look at the deal. I mean, you know you're not going to be, unless you can really talk them down on the price. You know you can't cash flow that property at $168,000. It just does not work. I want to run this same exact deal on a cap rate, okay? So we're at 9.2% cash on cash. If you're going to run it on a cap rate, let's say you don't want to do all of this right here. You just want to run just your numbers on a cap rate to see if the deal makes sense. And there's a certain number that if it makes sense, if you're looking at a deal and it's 7.5% on cap rate, chances are that deal is going to cash flow whenever you pull your equity out. Now, it might not cash flow if we see 8% interest and 10% interest. It's not going to, you got to really look at these numbers. Don't just think that everything is working perfectly regardless of the interest rate, regardless of the price. There are variables that are moving back and forth, back and forth, back and forth, and you have to understand them. So we can go back and forth and we can do these videos over and over and over to try and help you better understand how to dissect it down, how to look at a deal. Maybe I say something today and you don't quite understand it. Maybe I say it tomorrow and I say it a different way and you're like, aha, now I got it. So that's ultimately what we're looking for on that right there. When we step to this right here, a cap rate is the real estate valuation measurement used to compare different real estate investments. Although there are many variations, a cap rate is often calculated as a ratio between the net operating income produced by the asset and the original capital of the asset, the cost of the asset itself. So most of the time where people are buying property and they're using cap rate is on commercial property. They're buying off of the cap rate. We'll get into that on a different video. It's a little bit more complex, but we can still use it on residential. And this is the calculation on that right there. So we took the house. The cost of our home was $120,000. The closing cost at 3% with the $5,000 worth of repairs was $3,750. Exact same numbers as we used in the previous video. Now we're at $128,750 total investment. We're not borrowing any money. We're paying all cash. I got $128,000. I'm going to pay for this. So we know from the previous slides that the $120,000 does make sense to buy. We can make money at 9% return on investment. That's not a bad return. So we're going to use $1,350 as the monthly cash flow. $16,200 a year. We're going to put our vacancy factor back in it. That's going to be $1,134 a year, which gives us a total cash flow that year of $15,066, and I didn't put any cents on it. We're going to use the same property management fee of $1,205, insurance $1,200, taxes $1,600, maintenance, legal. So our total expenses are going to be $4,905. The difference is we don't have any fees in here for a mortgage. That's why the fees are different than the cash on cash was. So this is yielding us a 7.8% cap rate. So in the environment of 6.5% interest, we can finance that deal and make 9% return on investment. So you make a little bit better at that financing at that right there, but we're still making 7.8% on a cap rate. So play with those numbers. Again, you could take that right there. You can multiply it times 1% and say, okay, this is what the deal is going to cost me if I finance it. It's going to be a pretty close number. If that number doesn't work, walk away from the deal. If that number works, go into further dissecting that deal. I'm not telling you buy that deal. I'm telling you further dissect it. Every nook and cranny, lift up the bed sheets and see what's in there. Let's find out what's going on within that house and know everything. Never neglect a full evaluation of your property. Under the house too. If you're not willing to go under the house, hire somebody that is, because you have to know what's going on under these houses also. So that gives you the numbers on this deal in Gallatin. If you like the video, if you like what you're hearing, please subscribe. Please follow us. Let us know. We're going to give you some more information. It's going to get better and better. And we want to give you what you want. If you got anything that you need, please put a comment in the bottom. Let us know, hey, can you evaluate this type of a deal? And send us that information. We'll do our best to get it online and get it where you can see it, and we dissect in your own personal deal down for you. Thank you very much. Have a great day.